So I decided to do another one of those videos talking about some common mistakes and some things that I disagree with in the market and how I personally think about it and try to solve the problem. Next time I'm going to talk about the whole thing about timing the market, you can't time the market, and how people really use it to kind of justify some other things which I believe are not true. So the topic of today is the whole thing about macroeconomics. You see my videos and pretty much every single person now on YouTube is doing macroeconomic videos talking about the Federal Reserve. Everyone is a Credit Suisse expert and credit default swaps, if you remember, car expert and just a lot of things. So if you remember in 2021, what was the topics in 2021? It was about valuation, Warren Buffett and Cassie Wood. Why is the stock is gonna 10x or whatever? How do you value a company? How do you do this? How do you do that? You can't time the market. Don't pay attention to the Fed because you can't time the market. This was the whole thing in 2021. Well, in 2022, it's completely different. It's all about the Federal Reserve and macroeconomics. Well, in my opinion, as I said, if you want to outperform most investors, you have to do the opposite of the consensus. So now I believe the biggest mistake investors are making is they're getting too carried away with the Federal Reserve and with macroeconomics, and they are forgetting, one of the most important things in the stock market, which is valuations, which is one of the reasons I only do one of those videos per week around macro, and everything else is valuing companies. Because I want to keep reminding investors that valuations win in the long term. And if you really obsess over every single Fed move and what this happened and every single day, in my opinion, it's really going to hurt you whenever you're finally going to buy stocks in the stock market crash. You may say, what do you mean by that? Well, I'm going to tell you what really happened in 2008 with many investors that I know and I didn't know, and I saw them on television and stuff. And investors before 2008, again, they were all about valuations, PE ratios and free cash flow, DCF and all that stuff. In 2007, 2008, everyone is suddenly obsessed about the Federal Reserve and macroeconomics. All right. And as we've been going into the stock market crash in 2009 and 2010, you had stocks like Visa, which was really hurt in 2008, mainly from consumer spending and plenty of other things. Now, the company Visa was trading around a 14 to 13 PE. So 14 PE for Visa. You had Costco at 13 PE. You had many of those legacy type of companies, which we can all agree, even in 2008, they're not going anywhere anytime soon. They're not going under, or nothing bad is going to happen to them. You had Moody's, which issues the credit rating. It was sitting at 10 PE, which has, I believe, was a 25 or 30%, return on capital. But people did not buy those stocks. Why? Because, it was the whole macroeconomic environment was bad, consumer spending was bad, Visa is going to suffer. You had, people like Harry Dent saying you should sell all your stocks because we're going to have a depression, even as stocks recovered after, the Fed issued liquidity in 2009. So many people did not buy those stocks, even though the valuation was very, very good, because they got too obsessed over macroeconomics. And I believe it's going to happen this year again. And it's starting to happen, in my personal opinion. As I said, everyone is Credit Suisse expert, credit default swaps, Carvana and all kind of economics. But what about valuations? Again, this is the whole thing that I'm trying to talk about, how people shift from one side to another, and normally you should be able to take the opposite side. So what I personally do in my portfolio is, when I'm looking into a company and I see that we have a bad macroeconomic environment, which is something we have to pay attention to, I look at the company's earnings and I see if the earnings are somewhat sustainable. It means they can't really go down much, or they're gonna grow a little bit less, but they are somewhat sustainable. I open a position. Or if it's something, for example, in the advertisement, like for example Meta, which I still don't own, but let's assume I decided to buy Meta. Well, if Meta was cheap enough to compensate for such macro risk, again, I open a small position and I add to it later. And this is why I believe many investors will miss buying into the stock market crash, because we're going to have companies at amazing valuations, but retail investors are going to be so obsessed over macroeconomics, why it will be worse than 2008, worse than 1929. And again, last year they were saying, the Fed doesn't matter because you can't time the market. Well, this is, the whole thing that I'm trying to talk about. And I believe, both are important. I wish, companies still traded at just valuations like they used to do in the past. But sadly, we have to pay attention to the Fed. And again, I don't like it, but this is just what we have to do after 2008 when they pretty much broke the stock market. So this is kind of my advice for investors. It's not financial advice, but it's that macro is important. But if you find a company that's cheap enough to compensate for the risk, or if it's, something that could pretty much hold up good and the valuation went down a lot, you could maybe open a small position. And especially if we do have the big crash that we keep talking about, don't really just obsess over macro whenever we hit 3,000 or 2,800 and people are gonna say we're gonna go to 2,200, or you shouldn't buy Costco because people are not going to eat anymore or whatever. So again, just pay attention to valuations too. I think they are important, and I'm going to continue doing my valuation videos on other stocks just to make sure that we keep both things, because both macro and valuations are important. If I just want to make market crash videos, trust me, I'm going to get much more views than just doing analysis videos. But I want to keep doing both, and I think you should pay attention to both, as both of them are important and valuations win in the long term. So this is my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.